Welcome to It's the Economy, and that's the most important topic today, isn't it? The Fed has raised rates as expected, but its statement and the Jerome Powell presser indicated the terminal rate would be more than what the Fed initially thought. That seemed to be the most important statement that spooked the market. The dovish part of the statement was that it indicated the Fed would take note of the impact of the hikes taken so far and the fact that they take time to impact the market. The statement, however, added that slowing of the pace may be discussed next meeting or in the one after. Risk assets have since fallen very sharply, but to understand more about the impact of the Fed hiking cycle and the statement today, I have with me Stephen Glender, Global Head of G10FX Research in North America, Macro Strategy at Standard Chartered, and Robert Sockin, the Global Economist at Citibank, both joining me from the United States. So thank you very much, gentlemen, for staying up so late for us. Steve, if I may start with you, what is the key takeaway from the statement? Is it that if everyone thought the terminal rate is going to be 4.62 or thereabouts, it's now going to be increased to probably 4.88 or thereabouts?
Well, I think if it's only increased to 4.88, the market will deal with it pretty well. He just seemed to leave it open-ended. And I was a bit surprised. I mean, there's only been one CPI and one payrolls report since the last FOMC, since the September FOMC, where they, put the, 4.625 forecast down. So it's hard to see what deteriorated so much that Powell had to take such a hawkish tone with respect to, how far rates might go.
Today, would you take away from the statement and the presser a feeling that rate hikes could be more than what you thought before the meeting?
Yeah, I mean, that's certainly the case. Our forecast remains. We haven't changed it, that they'll do 50 and then 25. In order to get that, we're going to need to see the economy slow down in a significant sort of way. We have three payrolls reports, 3 CPIs before the next FOMC. So, yes, hopefully the numbers go in a way that go in our direction. That said, it's clear that he was expressing disappointment with where the numbers, had turned out, and that what he wanted to do was elevate the market expectation of how far Fed funds could go. And as I said, he succeeded admirably. Even though, we still have to see how the payrolls report does this on Friday and how subsequent data come out. I'm not as convinced as he is that the economy is that robust.
No, I take your point. There were very clear statements. Despite the slowdown in growth, labor market remains extremely tight. I'm just quoting from the presser. There is no indication inflation is coming down. Recent inflation data have come in higher than expected. All statements from the presser. Robert, what has been the takeaway at CITI? What were you expecting in December? What are you expecting now?
I think, thanks so much for having me. You can break it down as you have into sort of two components. So markets reacted dovishly initially because they were looking for signs that the pace of rate hikes might slow. And you got that very much in the statement where it said that they would take into account the cumulative impact of rate hikes, as well as the impact of the lags of those rate hikes over time. So to us, that was a clear signal that the pace of hikes would slow at the upcoming meeting. There's still a risk that they could do 75 again in December, but going into the meeting, we were expecting them to signal a slowdown in the pace of hikes and to move to a 50 basis point tenor in December. So they very much delivered on that point. Then you move to the press conference, which was more hawkish than we expected. And Chair Powell really took pain to emphasize there's a difference between the pace of rate hikes, which they very much want to start to slow, and the amount that they're going to have to hike. And relative to September, they're going to have to hike likely substantially more than they were initially expecting. And so the tone around that took us by surprise. In particular, something that was very striking in the press conference is that Chair Powell clearly showed a preference for over-tightening versus under-tightening. Yes. He said if the Fed were to over-tighten, they could use their tools to support growth in that scenario, and at least inflation would be coming more towards target in that scenario. However, if they were to under-tighten, then inflation expectations could become unmoored, inflation could become even more of a problem, and that could lead to even more employment costs down the road. So that was, again, a clear hawkish signal that the risk to rates are to the upside. Yes. And so going into this meeting, we were looking for a terminal rate. That is where the Fed is going to stop in this cycle of 4.5 to 4.75. But we now increase that by 75 basis points. So we actually are looking for 50 basis point hike in December, another 50 in February, and then 225s after that. So we've raised our terminal rate by 75 basis points.
Oh, that's a great deal. I mean, 75 basis points more in terms of a terminal rate. So the terminal rate becomes 5.5 for CITI, is it?
Yeah, we have 5.25 to 5.5, reaching that in May. And again, it comes down to this hawkish emphasis. And Chair Powell said himself that so far data have been resilient, inflation is very persistent, and the labor market is still very tight. So those factors, I think, are pushing them to signal a higher terminal rate.
Okay. Steve, 5.5, what would your terminal rate be, you said?
Well, we're still at 475, but the risks are to the upside, clearly. Okay. I mean, he was pretty adamant that, they're going to do at least 50, and, that he wanted to expand the horizon of how high rates could go. I happen to disagree with the view that there's more risk to over-tightening or to under-tightening than over-tightening. I think if they find themselves, say, at 5.5%, and it turns out the economy is slowing precipitously, knowing how much to ease at that point is going to be a very difficult monetary policy. Right. And we'll be back in the stop and go world, which I think for a central bank is actually the worst place to be. Yeah. Again, I think it depends on how the data go. I'm not as convinced by the JOLTS data. They look very anomalous, say, as compared to real wages that are still falling. Some of the other indications we're getting from the economy. I think that the Fed will back off if it turns out that the economy is
I agree. I agree with you.
Than he thinks. Yeah,
I agree with you that this is dynamic, and he could, shift later in a future policy. But at the moment, Citi going with 5.5. But Steve, how do you expect the dollar to behave? You think the worst is now priced in and it doesn't go above this 112, 113 levels?
Well, the dollar's had a hard time going, I think it's about 1% off the high of the dollar index.
Yes.
And it's bounced off that ceiling a number of times. It'll be important to see if the gains that it had today persist. If they don't, I think the market's going to look at these levels and kind of say, look, it's bounced off them 4 or 5 times in the last month. And that would open up, just on a technical basis, more dollar downside. What it would mean on a fundamental basis is that the market had absorbed all the dollar positive news, and FX markets were well positioned for a strong dollar, and there just wasn't that much more information there to propel the dollar. So, the next 1 to 1.5%, I think, are critical.
And you think the rupee could still get weaker? We bounced off from 83 and came all the way down to 82. You think 83 or even beyond that is a danger, is a possibility?
Well, we think 85 is a danger. Oh. I mean, with oil going up in price and the Indian current account, vulnerable.
Yes.
The RBI has been trying, very aggressively to limit the weakness, but we think there's still upside.
Okay, Robert, I want to ask you, what do you make therefore about risk assets and the way they are responding to growth? If 5.5 is the terminal rate, and we're going to get to 5 pretty much in February by your estimate, do you think the equity markets will now start factoring in a slowdown in earnings?
I think there's a need and a likelihood that earnings estimates are going to have to come down. In some of the work that we've done, we found that globally, in our base case scenario, which when we originally wrote the piece was before the Fed was even going into the fives, that earnings per share globally from a bottom-up perspective, we're going to have to come down over 10%. For where they are now. So I think there's definitely going to be more baking in of these more recessionary-like downside risk scenarios. And it's going to take time to process and pull those into risk assets. But, I think, we're at a point where, the Fed has clearly signaled that it's moving in a hawkish direction. It's going to take time for that to digest. And, there's arguably still some upside risk there to policy rates, which could be even more downside risk to equity markets and growth and growth-related assets.
Okay. Well, just a final word from you, Robert. 4.11 to 15 on the 10-year U.S. Treasury. Does that go higher, or has it factored in most of the hikes?
I think at some point it has to be hiking, it is incorporating a lot of both the path of policy, but then the slowdown to growth. And so, that's probably looking somewhat closer to fair value. You could get a little more upside in there, depending on, in the near term. But longer term than that, I think it'll depend on the extent of the U.S. slowdown. So right now we're forecasting a pretty mild recession in the second half of 2023, and then so you can get a strong growth bounce back after that. That's a very different scenario than if you end up in a prolonged growth slowdown. And you end up with lower rates for longer after that in the next cycle. So I think it's going to depend crucially on how the expectations evolve for the upcoming recession next year in our view, and then how long that lasts.
Okay, fair point. Of course, we are living in a world of many moving parts. Steve Englander, Robert Sockin, thank you very much for staying up for us and giving us the benefit of your analysis. The key takeaways from our guests is a bit disturbing at the moment for growth. It's definitely going to take a beating if the Fed will go all the way as Citibank sees it, all the way to 5.5, 5.25 to 5.5. So there could be more slowdown than what the equity markets are prepared for. But on the other hand, the Fed can always change its mind when it sees a distinct slowing. For the moment, all good news in the form of a very good jobs data is going to be bad news for the markets, or so it seems. Thank you very much for watching this special edition of It's the Economy. Time for Chartbusters.
Brought to you by